So somewhere between 9:30 and 10.
Hey Dennis.
I think it's.
While you guys help yourself to some breakfast and take a seat, I'll go ahead and get started. But feel free to move around, and if you miss something, just interject, and I'll be happy to backtrack or answer questions as we go along. But the more questions we get, the more entertaining this presentation usually is. So please interrupt me. We do these little get-togethers to show off what we do a little bit. We are Cush Capital is an investment management firm. We manage portfolios on behalf of individuals and 401ks and trusts and estates, and we market ourselves based on a better brand of research, and that's evidenced by a Morningstar rating that we got earlier this year. That was a big feather in our cap, and we were very proud to be able to say that we had been rated by Morningstar. We practice golden rule investing, which is just another way of saying that we have all of our own monies invested alongside of our clients. We wouldn't take any risks for our clients that we weren't also willing to take for ourselves. And then we can dial up or down that risk according to an individual client's risk tolerance. We're generally pretty conservative. The first rule of our investing approach is not to lose it. First we want to preserve our clients' capital, and then we try to grow it. We practice a biblically responsible investing approach, and we're a certified Catholic practitioner, which is our effort to integrate what we do on Sundays with what we do the rest of the week. And that's important because if you don't know what your advisor's beliefs are, you really should. It's a more important question than most people realize. And then we seek to do business with like-minded investors, and this is part of our effort to find like-minded investors. If we can sit down and have a conversation with somebody and come to find out that we have a like-minded worldview, then we simply get paid to execute a strategy that we both believe in. So I always start out with a few slides about our worldview and what we see going on in the global marketplace right now. And more so than anything else, what affects the decisions that we make on a daily basis is debt. Total debt outstanding in the United States and in the European region and Japan and China, and really on a global basis, we have big problems in combating the total levels of debt that we have right now. This slide's a little bit hard to see, I apologize for that, but the main point is that our debt has been skyrocketing. This slide details home mortgage debt, state, local, federal, consumer, household, business, across all sectors of the United States economy. And it totals over $50 trillion in 2009. And if you add Social Security and Medicare on top of this, the unfunded liabilities, it surpasses $100 trillion, which is a number that's too big to get your head around. So we have this chart, which shows what happens if we continue to spend $3 for every $2 we take in tax revenues. We call this the path to socialism because the bars indicate the percentage of our gross domestic product that is government expenditures. And you can see here that the top section of that, or the red section of that, represents just the interest that we pay on our debt. So if we continue apace, then in the out years, the interest that we owe becomes our economy. This is it's an unsustainable path. It can't continue. But in order to get back on the right course, we have to increase our tax revenues, lower our benefits, or stealthily increase our money supply so that we can pay off these debts with currency of lesser and lesser value. And increasingly, we think that's going to be a part of the solution. And as it is a part of the solution, then we're positioning our portfolios to profit from that. So these are gold, silver, other commodities-based investments, oil, real estate. We have some dividend-paying securities that we believe will fare better in a higher inflationary type environment. And then I think hopefully the idea that we have for you today will also come across as one that fits into our broader general thinking on the global economy.
Hey, Vern. So I've been coming to these for 2 years now, with Cush for almost a year, but I just noticed that last slide is actually a government, so the source on that is the GAO. I've never even known.
That's one. That's one
not
of the,
some slide that.
No, that's one of the ironies of the problem is that this is known, and this is known at inside of the government. The problem with solving the problem is to get yourself elected on a platform of cutting benefits or raising taxes is an extremely difficult thing to do. You can know what the problem is, and you can know what the solution to the problem is. Implementing the solution is an entirely different manner, because educating the voters is a very difficult thing to do, and getting them to act in their own long-term best interest at the expense of somebody's short-term best interest is challenging, to say the least. So, 2 quick slides on the market. This is a slide that details the market environment from 1980 to 2000. Think about this as about the time we were amassing a good portion of this debt. This is the economy on steroids, and it's a big party. In the last 10 years, we've seen something different. This is a volatile market where we're muddling through, to use a term that John Malden uses, or Bill Gross has referred to this as the new normal. Vitaly Katznelson, professor at the University of Denver, calls this a range-bound market. And ultimately, this is the type of market where you really need a firm that can dig into the research, a firm that, like Cush Capital, that prides itself on getting to know the companies that we do. So I've included a couple of new slides. Everything that I've just shown you are slides that we show every month. This month I've tried to include 2 slides that deliver a fresh perspective, and this first one is debt to revenues. So total debt in the United States and other sovereign nations divided by the amount of tax revenues they take in. So you can think of this as like a mortgage on your house. That is the typical ratio that lenders look at to see what amount of borrowing that you would qualify for. So on the left side of this slide, you see defaults from Mexico in 1827 to Argentina in 2001. And Mexico defaulted at a debt to revenue ratio of about 4 to 1. Spain defaulted in 1877 at a debt to revenue ratio of about 16 to 1. You can see Mexico in 1982 was just over 4. The Philippines in 1983 was not even 2. Russia in 1998 was just over 4. And then most recently Argentina in 2001 was just over 2. Now look at the right side of the slide, and you can compare the defaults of history to our current situation, where the United States on the very far right is right at 4 to 1, debt to revenues. Japan, 16 to 1 debt to revenues. We wrote a lengthy white paper on Japan's situation back in May that's archived on our site. They're in a very dire situation that has a big influence on how we manage our clients' portfolios. Second slide that I have for you new this month is a chart that shows total on and off balance sheet government liabilities. So I mentioned a minute ago about how the debt that we publicly report is only a fraction of what we really owe when you consider the promises that we've made to ourselves in terms of paying Social Security and Medicare. And we're not alone in that regard. You can see here that Germany, Spain, France, Italy, the United Kingdom, the European Union as a whole are all equally as bad off. And as a matter of fact, the United States is one of the worst on this slide. The European Union as a whole, which is the second from the right, has total on and off balance sheet liabilities of 434% of GDP. So while Greece and Italy and Spain and Portugal and Ireland are butting up against liquidity concerns, on the whole, the European Union is in a better situation than we are in the United States. And this is part of our working theory that there is a path through this current melees that we're working, that Europe specifically is working themselves through. And as a part of our working thesis, we were using as a template what we went through in 2008, where ultimately we were able to inject the liquidity that we needed into the economy. But before the politicians had the political cover to do it, we experienced significant turmoil in the markets. And as we look at the opinion polls in Germany and other Euro nations today, we don't see the political will to accomplish the types of mass bailouts that they would need to solve the problems that they've gotten themselves into. So in the short term, we expect a lot of volatility. In the longer term, we can see a light at the end of the tunnel. They can work themselves through this problem, but they don't have the political will to do it just yet, so we expect more pain before we see the ultimate solution. Okay, so the obvious question after all of these negative slides is, how do you manage a portfolio in this type of environment? And G. Willie Foods is an example of how we manage a portfolio in this type of environment. We try to build a portfolio of companies like G. Willie Foods whose fortunes don't have anything to do with the broader macro environment. I think this is a great example of a food distribution company that has very stable earnings and is very recession resistant. This slide speaks to how we approach research. We have a framework that we look at when we are doing our research on an individual company, and we call that the 3 M's, where we first look at a company's management team, then we look at a company's moat, and then we look at a company's mispricing. And a company really needs to have all three before we'll get interested in making a purchase on behalf of our clients. Management team is a very big indicator of protecting our clients or preserving our clients' wealth. We seek to pair our clients' capital with people of extremely high integrity, and more so than anything else we do, pairing our capital with other people of extremely high integrity is going to protect our downside. So it might not be the best investment we've ever made, or it might not be that next 3-bagger or 4-bagger, but we have confidence that we're protecting our clients' capital if we can identify management teams of extremely high integrity, of track records that are shareholder friendly. We look for companies with a moat, and this is a finance term that means that there's something about the company we're making an investment in that allows them to fend off their competition and protect and sustain slightly higher margins. And then we look for a mispricing, and this is management team is very important, moat is very important, but we just absolutely cannot sacrifice on mispricing. There has to be something about the company, something about the internal workings of that company, or something Wall Street at large has missed that gives us the opportunity to come in and buy at a price that's undervalued. So G. Willie Foods is a kosher food distribution company. So even in the worst of the worst recessions, people are gonna need to eat, and G. Willie Food distributes kosher foods predominantly in Israel. 80% of their business is in Israel, and then 20% of their business is in the United States, Europe, China, and Brazil. Desserts, ice cream, chilled and frozen foods, butter, cheeses, coffee, tea, pastries, canned fish, pickled goods, pasta, rice, noodles, all sorts of food commodities. They're one of Israel's largest food importers with over 1,000 products. They distribute to over 1,500 clients in Israel. Their business strategy is to kosherize successful products from around the world. So if there's a successful food product in Europe or Brazil or China, they'll go out and contract with the food manufacturer and help them to re-engineer that successful food product to make it kosher. And to do this, you have to have relationships with the right rabbinical authorities, and G. Willie Foods has those relationships. This is the aspect of their business that creates the moat that we look for, because they have an expertise in kosherizing these products. Whereas if they're working with Del Monte or another food company in Europe, they might not have that expertise. And without the efforts of G. Willie Foods, they wouldn't be able to create this new market in kosher foods. So that I spoke to the redesign of products that creates the moat. Okay, I think I hit all the points on that slide. So our investment thesis on G. Willie is very simple. This company is simply too cheap. It trades at less than 4 times their earnings. They earn 60 cents a share, and a company like G. Willie, if you look across other food distribution companies, they typically trade at about 6 times earnings. That's a fair ratio for a food distribution company. To put that in a little bit of context, if you look at the S&P 500 index over the last 50 years, the S&P 500 index typically trades at a ratio of about 15 times earnings. Food distribution companies typically trade at about 10 times earnings. G. Willie trades at 4 times earnings. It's just, it's simply too cheap to ignore, and I'm going to answer the question about why it got too cheap, because that's key to the investment thesis. Typically, I'll touch on that in a minute. The earnings are real, sustainable, normal, very defensive, and repeatable. So oftentimes when you see a company that's trading as cheap as G. Willie is, you'll see something about the earnings that's not repeatable. Something was one time in nature. They had a big sale of one of their businesses, or they're benefiting from the sale of a product that's a fad or a short-term trend. Well, there's nothing about what G. Willie does that we don't expect to repeat next year and the year after and the year after. And aside from that, they've been able to successfully grow their earnings at about a 15% clip over the last 5 years. So it's growing. There's the potential for multiple expansion. We expect G. Willie to trade up from 4 times earnings to 10 times earnings, and that is something that we call multiple expansion, which will be driven by a $10 million share buyback that they've just implemented. International expansion. They're looking to expand their operations into the United States and Europe and grow that part of their business. I mentioned the 15% organic growth. And then they recently signed, just last quarter, a contract with Del Monte, which their CEO, Zwi Williger, he described as a huge opportunity on their conference call, but has yet to be factored into their earnings. So the core business we value at $6. Their current 60 cents a share in earnings times normalize the multiple of about 10 times, plus $4 in cash that they have on their books. And that's another big factor driving the story, is all the cash that they have on their books. And I'll touch on that too. Any questions about Zwi Willie so far? Okay, so let me address that question about why this stock is so cheap, because that has everything to do with why we're owners of the stock and why it's a good value today in the market. So I showed the stock price, this chart there. Why the stock is so cheap, and again, we're looking for factors that have depressed the stock that we think are reversible or short-term in nature. The first of which, it was in March of 2010, they did a dilutive secondary offering. So the stock was cheap. They went out and issued more shares. So if you're an owner of Willie Foods and they issue more shares, then your earnings per share decline. And that's typically not something that you want to see as a shareholder. It's not something that we would want to see. And I asked the management team about this directly, and the CEO told me, yeah, I understand in hindsight it was something I wish I wouldn't have done. I liked that he showed a little bit of humility when I was talking to him on the phone. And he said, I never would have done it if we were not on the cusp of what we thought was going to be a transformational deal, meaning that we could significantly expand in the United States. They thought that they had an opportunity to buy a food distribution company in the United States at near fire sale prices that was going through a bankruptcy. Well, somebody else stepped in, bought that food distribution company, and all the cash that they had raised in that secondary offering just sat on their balance sheet. And it's been sitting on their balance sheet since March of 2010, so for a year and a half now. So as you can imagine, if you were one of the shareholders of Willie Foods and they went out and told you that they were going to do a transformational deal and then it never got done, and they've held this cash for 18 months now, you can begin to get a little frustrated with the management strategy. we take that as a positive sign. So oftentimes you see management teams chase deals for the sake of growth, and M&A, mergers and acquisitions activity, has been shown by many consultants to not add that much value over time. So the patience that this management team has exhibited in putting that cash to work is a positive sign when we're analyzing this company. So that's 1 and 2, the dilutive secondary offering and the growing investor frustration. The third reason why the stock is so cheap is a false insider sell signal. Earlier this summer, right about June, and you can see it markedly here on the price chart. June and May is right in here. There was a big insider sale, and anytime one of the company's officers or executives sells part of what they own in a company, they have to file a form with the Securities and Exchange Commission, and other investors see this, and it's rightfully a cause for concern when you see the owner of the company selling his stake. And that's exactly what happened with Willie Foods, and the stock subsequently sold off. This is entirely rational. But what Wall Street missed is that the CEO took the proceeds from the sale of that stock, and he bought shares in the parent company of Willie Foods. So Willie Foods is majority owned by a parent company that is a holding company that owns other real estate investments and part of an insurance company. The CEO wanted to consolidate his ownership underneath the parent to prevent somebody else from coming in and taking over the company at what were then prices that much lower than he thought the company was worth. So this is actually a defensive move, not anything that indicates a problem going on inside of the business, and not anything that indicates that the CEO actually lessened his ownership. When one of the reasons Wall Street missed it is because the parent company is traded on the Tel Aviv Stock Exchange. So when you take the proceeds from the sale of Willie Foods, that's traded on the NASDAQ, and plow them back into the parent company that's traded on the Tel Aviv Stock Exchange, there is no filing that represents the offsetting purchase of the sale of these securities. So number 3 was a false insider selling signal. And then number 4, which was primarily in the last 2 months, you've seen the rise of the U.S. dollar. So when debt concerns in Greece come into light, and the global investing community starts to worry about their ability to pay back their debt, there's a huge flight of capital out of Europe and into the dollar. Hundreds and hundreds of billions of dollars leave Europe, and when you're moving amounts that are that big, there's only one market that can soak it up in the short term, and that's the U.S. dollar, U.S. Treasury, and that's evidenced by the U.S. Treasury falling below 2% last month. So we think this is a situation that will reverse itself in time, because we don't understand the purchasing decision that an investor makes when they put their hard-earned money into the U.S. Treasury, yielding less than 2% for 10 years. So we have share buybacks that address number 1 and number 2. Management team has committed to putting part of that cash hoard to work, buying back their own shares, which is a very bullish sign that they want to buy back their own shares in this market. They recognize that they're undervalued. Number 3 was a false signal, and number 4 we expect to reverse in time as the U.S. dollar eventually runs into its own trouble, and that's represented by all the charts that we showed at the beginning, whereby the United States is in every bit as dire of a situation as Europe is. So other key points that we like about Willie Foods, kosher foods as a category grew at 64% between 2003 and 2008 and continues to grow at 15% a year. This was something I learned in doing the research on G. Willie, is that kosher foods is seen by many people as a health food. There are much more stringent requirements in the manufacture of the food, and as such, people who are attracted to organic products and other health products are often the same people that are attracted to kosher foods. It's also appealing to other religions. Muslims eat kosher foods, certain Christian denominations, Seventh-day Adventists. So it's a very quickly growing food category. The $10 million share buyback, the total value of this company is very small. It's less than $80 million. So they're taking 10 million of that, so an eighth of the size, an eighth of the whole company is being spent right now to buy back their own shares in the market. So this sets what we think is probably a floor underneath the price of the stock, or at the very least limits the downside that we expect here. They recently signed the exclusive agreement with Del Monte that the CEO described as a huge opportunity to distribute kosherized Del Monte products throughout Europe and Israel. And then food price inflation. This was a surprise to us when we were doing our research. Food price inflation is typically a very negative thing for a food distributor because it compresses margins across the entire value chain. But for Willie Foods, it might actually work in their favor because there were riots earlier this year in Israel over food price inflation, and the government stepped in trying to do whatever they could to help consumers out. One of the plans that they came up with was to put pressure on the grocers to give shelf space to more competitors that could make the environment more competitive. So Willie Foods is actually winning market share from companies like Nestle and Unilever as a result of this food price inflation. So it is having an effect on their margins, just like food price inflation always does. But Willie Foods has been able to offset that with increasing market share in its own market. So it's a risk in the long term, but in the short term, it's something that Willie Food has found a way to benefit from. So that's it on Willie Foods. 4 times earnings. It's super cheap. It's recession resistant. These earnings are repeatable. They have a share buyback. They have everything we look for in a company that will allow them to prosper and benefit and grow through this period of turmoil that we're in, while the globe as a whole tries to manage a massive and excessive debt load. So, Mike, what did I miss? Go.
No, I got questions. Go ahead.
No, I just wanted to, this is coincidental more than anything else, and I don't know if it's a fact or not. I'd be curious if you do know, but I have a very, very good friend who's Jewish and who has a eating pattern that I find to be kind of standoffish. But he was, I was talking with him about, the things that he was eating, and he was talking about his kosher diet. And I said, I really don't know that much about kosher food other than the fact we all see it all the time. I see it in my grocery store more often than I ever did before. He said, do you know who the largest consumers are of kosher food? And of course, my immediate thought, the obvious answer would be, well, Jewish folks. He said, no, Christians. He says they are the largest consumers of it, and it's because of that point you made about the more healthier aspects that people believe that food has.
That was came as a complete surprise to me when we started doing the research. We were initially attracted by how cheap the stock had gotten. We really set out on an effort to try to explain and understand why it had gotten so cheap, and this was something we were very pleased to hear. It continues to allow for the category as a whole to grow at about 15%. So, Mike, did you have a question?
Yeah, and I don't know if this is on point or not, but for outstanding shares on this particular stock versus a thinly traded stock, how much bearing does that have on any or all of this?
That's a great question, and you should be careful when you're trying to trade a thinly traded stock, and Willie Foods is a thinly traded stock. I forget what the average daily volume is, but as a general rule of thumb, you should try to keep your own purchases less than 20% of the average daily volume in order to not move the stock. So we try to do that internally anytime we're trading a micro cap investment opportunity like this.
Is there much institutional interest in this?
No, that's that's one of the opportunities, is that a company like G. Willie can fly underneath the radar of a lot of the larger brokerage houses on Wall Street, because it's just not worth their time to dig into this story, because they can find a great story and then they can go out and sell it, and there's not the volume to sell to their client base. So historically, smaller cap companies like this have been one of the playgrounds of investors, and have allowed for them to earn outsized returns in the long run.
How much of that $4 a share was that secondary offering?
Most of it.
I mean, have you done the math on it? Is it $4? Should it be $4? Should it be $5? Should it be $3? I'm just curious.
Well, right now they have $4 in cash on their books, and I want to say that secondary offering was 70–80% of that off the top of my head, but don't hold me to that.
Vern, two quick questions. One is this insider sale that resulted in the investment on the Israeli exchange. Did that change the dynamics? In other words, does now the owner of this company have control over whether the parent is able to sell, or I mean, what did it change effectively?
Effectively, it made it so that Zwi Willie, who is the CEO, or actually the chairman of the board, and his brother, Joseph Williger, now have control over the parent and also Willie Foods, because the parent owns the majority voting stake. So this is a positive, because it prevents a corporate raider from coming in and paying us a price that's below what the company is really worth. And it's also a negative in some respects, because we're beholden to the chairman of the board and his brother that own the majority of interest. So we have to be highly certain that they are indeed people of high integrity.
The second part of this is just the buyback. In my experience, buybacks are questionable as to the long-term value they create, and typically if there's excess cash, you either invest or return to shareholders. They're doing a buyback. You mentioned you think it creates a floor, but in reality, the stock can still go to zero. So I'm trying to understand the logic in this buyback, and I mean, it increases the value. I'm just trying to figure that out.
Let's see if I can. I agree with you that historically, if you look across all buybacks in the last 20–30 years, pick your time frame, that they have not particularly been good indications of value-added activities by management teams. And a lot of times you'll see management teams playing games where they'll announce a buyback to try to give their stock a little boost, and then that buyback will take years to occur, and they'll have kind of a natural, every quarter they go out and buy X number of shares. I don't think that's the case in G. Willie's circumstance, because they have so much cash on their books and they missed out on an opportunity to expand in the United States. So if they make 60 cents a share now, and they can go out and buy back 10% of their shares in the open market, then next year they're going to make 66 cents per share. And if nothing changes and the market is still willing to pay them 4 times, put a 4 multiple on their earnings per share, as we would call it, then the share price would go up by 10% too, as a function of the reduction in share count. We think that it'll serve as a catalyst to force the market to realize that there's more value inside of this company. But does that answer your question?
I want to touch on your initial statement on the big picture of real estate, oils, gold and silver. Obviously, food is a commodity. If we're looking at the long-term debt, we have to believe that there's significant inflation somewhere in our in our future. In the past, at least here in my familiarity, people have gone to buying less expensive foods. The Walmarts have done well through these tougher times. And is the kosher food a more expensive food where people have food commodities continue to rise and go up, would move towards other types of foods and could affect the sale of that product? Have you thought about that or looked at that long term, or am I off base there?
No, I don't think you're off base at all. With respect to G. Willie's growth opportunities in Europe and the United States, I would say that comment is on point, because they are growing in the premium products that cost a little bit more. So they could sacrifice some of their growth. With respect to their products in Israel, which is 80% of the kosher foods markets, they compete on price, and that's exactly how they're gaining market share from Nestle and Unilever, because the government has come in and said, we want to see companies like G. Willie on the shelves, because it gives consumers an opportunity to have greater control over their own dollars that they're devoting to their food budget. So with regard to 80% of their revenues and profits, less of a concern. With regard to the 20%, that would be the premium food products that they work with other food distributors around the world to create and kosherize and then grow into the U.S. and European market, that could be a big concern. So we were very attracted to the growth part of the story, but it's not crucial to the investment case because the food distribution business is so cheap.
And do you wouldn't sacrifice like you would in a normal economy? Somebody that eats kosher foods is going to eat kosher foods. Is there a lot of different choices? Is the price points a lot different in kosher foods? You know what I'm saying? I mean, they're eating kosher foods. Like in a normal economy, if I don't have as much money and I'm going to go start buying my groceries at Walmart, I'm going there because they got the cheapest prices or whatever. And if I'm still eating kosher foods, I've got to eat kosher foods. There's just not the options that there are for me as a Catholic.
Yeah, for that section of the market that is eating kosher foods because it's a part of their religion,
Yeah.
they become much less price sensitive.
How did Whole Foods react over the last 5 years? Isn't that a pretty good success story, that grocery store that focuses on natural foods? Didn't its value do well? Do you know?
Oh, I've followed that one a little bit from time to time, but it seems like the last time I looked at it, it was still too expensive. But if my memory serves, they fell on hard times for some reason.
So people did choose to move out of $5 bread to $2 bread?
I'm certain some made that decision.
I think Whole Foods is a story about the ownership, though. There was an ownership issue there. I think it was Whole Foods. It wasn't,
Yeah.
so you can't.
Well, I couldn't quote it exactly. I was on Winn-Dixie's bankruptcy, and I can tell you that there is a high-end grocery demand. In the South, it was Publix, and Walmart had their discount space, and everybody else was that was the market share that was in trouble. So when you're in the high end, you've got a place, and that's where the kosher food is.
Well, Whole Foods has gone from basically about $9 a share to it's sitting at $68.50 today. So it's gone basically $9. It got up to high as $72 in the last 2 years. So it would have been a great stock down.
I'm just wondering if it's in that upper echelon. Obviously, there's still going to be people that can afford that.
Mhm.
If it's in the middle, it seems to me those are the ones that get hurt the most. But the commodity issue is really I was looking, this is way off base, but the farm ground, for example, what's happened to that recently in the last 3 or 4 years, and just the price of food itself going through the roof. How does that affect a distribution company like that?
We pay close attention to it as well. We're researching a company today called Cresud. They're one of Brazil and Argentina's largest landholder. They own farmland and a little bit of commercial real estate. And it would appear as though their land prices have lagged a little bit the global rise in farmland. So it might represent an opportunity.
I got So if I put my average investor hat on, where do you find this idea, and why haven't they expanded into Europe before? They're sitting right there. Why did they come to, and they're 80% Israel, 20% U.S., nothing else in Europe? Is there
the first question was, how did we find this idea? One of my friends over at the Buffalo Funds, I used to work for the Buffalo Funds, sent me a research report that he had seen. This was about a year, it was over a year ago now. And he said, this caught my attention, just wanted to make sure it was on your radar screen. And it was an interesting report, but we had other things going on at the time, and I just added it to the watch list. And I have seen Willie Foods hit the make news a couple of times in that last year, and then when they had the insider selling in the summer and the stock fell from 7 to 5, it just got too cheap for us to ignore it any longer. So it quickly matriculated up the list of where what our focus was, and we did the research and decided it was something we wanted on.
I just have a lot of people ask me where we get our ideas, so I want to do.
So our ideas come from everywhere. Our ideas come from meetings like this, and our ideas come from an investors club that we run, and our ideas come from several networks that we're involved in. You can think of them like as a LinkedIn for portfolio managers and analysts, where you can get together and stress test your investment cases and share ideas. And so that's a few comments on idea generation. And then what was the other question?
Why they haven't expanded into Europe before now? They talked about that?
They've been growing at 15% a year for the last 10 years. So why haven't they expanded into Europe before now? I'm not concerned about the fact that they haven't expanded into Europe before now, because they've been growing at a rate that they can manage. The Williger brothers have had a lot of success in acquiring other smaller food companies, including Shamir Salads and Golden Frost, and both of those companies have distribution into Europe. So it's a smaller piece of their sales that they're actively trying to grow, but it doesn't concern me that they hadn't been able to do it until now.
Quick question, Vern. You hear the term recession-resistant or recession-proof thrown around quite a bit. In your opinion, what makes something recession-resistant?
The more certainty we can gather with regard to the cash flows that a company is going to be able to generate next year and the year after, and through any kind of recessionary environment, the more we are likely to call them recession-resistant. Now, the market as a whole may disagree with you, because when people get scared, they have a tendency to want to pull their money out of the markets, and that may cause stock like Willie Foods to decline from $6 a share to $5 a share or $4 a share. But as long as the revenues and earnings that they're able to generate are consistent through that recessionary environment, then we know with near certainty that on the backside of that recession, we're going to get our capital back that we initially invested, and we're very likely to get our initial investment back plus interest. So we have to have the wherewithal to hold through a recessionary environment, because we recognize that other investors can get fearful, and that affects the quote that we get every day when we log into our Fidelity accounts. But as long as the earnings and cash flows are there, then we don't have anything to worry about with regard to what that investment's going to be worth coming out of a recessionary environment. And we think that a company like Willie Foods has the right type of business to sustain those revenues and cash flows through even the worst of it. All right.
Just for the record, I'm not texting.
No problem.
I'm taking notes.
So, thank you. Our plan is to post this video and the slides and our research report up on the internet. But grab one of these before you leave. This is the work that we actually did on Willie Foods. It's a little 7-page write-up that details everything I just went through here. read it yourself, share it with a friend, call me, email me with any questions. We're happy to do follow-ups, and let us know how we can make this event better, because we do it to spread the word, and appreciate everybody's time here this morning.
Do you post these, every one of these on your website? Like I went to the one last month. Did you post that on there?
It's in the process.
We're trying.
Okay.
We spend 90% of our time managing the portfolio and 10% trying to scramble to become tech savvy enough.
It took us it's almost taken us a month. It took me 3 weeks to figure out somebody that could actually do what we needed to do. So
We're trying.
you don't want us spending our time on that kind of stuff, so we haven't.
So thank you.
Okay.
Thanks, Vern.